my general approach to the markets is to identify what outcome is priced into the markets and try to, using my analysis of the economy, discern areas where that expectation might run afoul. And so right now we have a very firm consensus that we're heading into a recession. And so you have a lot of people out there saying, well, if that's a consensus, therefore, we won't have a recession, it'll be a soft landing, and that's the contrarian bet. My view is that the contrarian bet is that this recession is going to be as bad, if not worse, than the 2008 financial crisis. And I'll go into the reasons why. But the consensus, while they are forecasting a recession this year, expects the barest of recessions. They expect a short and shallow 2-quarter affair that almost barely meets the technical definition of 2 back-to-back quarters of negative growth. So yes, the consensus is forecasting a recession, but they see it being a mild affair. And I think that based on what the Fed's done so far, it will be anything but. And going back to that Fed tightening, I would encourage people to think about the Fed rate hikes that we've seen so far, not as a tightening cycle, but as an interest rate shock. What they've done in terms of the speed and magnitude of rate hikes is utterly unprecedented. I know people draw parallels to Volcker, and obviously the nominal level of interest rates was substantially higher then. But the rate of change that he undertook was nothing compared to what we've seen today. And importantly, or rather crucially, debt back then was nothing. I mean, today we are toting enormous amounts of debt, not just in the government sector, but in the consumer and more importantly on the corporate side. So the vulnerability to these higher interest rates is much higher today than it was in Paul Volcker's time. And I think one of the reasons why there's so much complacency about this soft, short and shallow recession is that so far the impact of the Fed's rate hikes has been relatively mild. I mean, for sure, we've seen an enormous decline in housing activity. But other than that, it's hard to see where we've had any dramatic impact on the economy. And you certainly haven't seen much of a dramatic impact on the financial markets. We had, a stock market correction last year, and we've since recovered our footing a little bit. And it hasn't been a panic or a crisis or anything that got out of control. And so I think that's imbued complacency about, what impact this full tightening will really have. And again, that's why I go back to the idea that it's an interest rate shock, and that so far we really haven't seen the impact. And when we do, that impact is going to be really profound, and no one's prepared for it. I can see you're like the cat that swallowed the canary over there, Adam. The fact is you're already seeing it reflected in a deteriorating credit quality. We've seen an uptick in credit card delinquencies, and obviously auto loans have really suffered. But on the corporate side, which is my primary focus, because after the housing bubble bust, consumers were pretty reticent to borrow aggressively. And while they have run up credit card balances dramatically in the last 12 months, they've done so really just to keep up with the rising cost of everything they can't live without. Right. And now, in the recent data, they've actually been trying to rebuild their savings a little bit. So I don't think the excesses on the credit side are really on the consumer balance sheet so much as they are on the corporate side, which was the primary credit taker during this free money bonanza. And Bloomberg just reported that in January, large corporate bankruptcy filings were the largest since 2010. So you're already starting to see things turn. And as I suggested with this idea that it was an interest rate shock, that hit when it happens, and like you said, it's just starting to come through now, is going to be much more profound than the markets presently expect. They're looking for sort of a gradual and modest deterioration in credit conditions. And I think we'll see something far more severe, and that it will play out much more rapidly. As you acutely point out, the interest rate hit doesn't happen until you have to pay higher interest rates, obviously. So, if you have an adjustable rate mortgage and they take mortgage rates to, 7% at the peak, that didn't affect you at all if you didn't have a reset. It only affects you when the time comes to reset. And the same is true, obviously, on the corporate side. And on that score, there are several myths around the strength of corporate balance sheets, but an important one is that companies shrewdly took the opportunity to lock in the incredibly low borrowing costs that we saw during the pandemic stimulus bonanza for as long as they possibly could. They borrowed long. And the fact is that they may have borrowed long, but they borrowed a ton short. And we know that because there's $1 trillion in corporate debt here in the US that has to roll this year. And then there's another trillion that has to roll next year. And there's another trillion in 2025. So there's going to be no relief from this impact of higher interest rates in the foreseeable horizon. And the only thing I guess that could stave off a significant wave of corporate delinquencies would be for the Fed to swiftly pivot and cut rates back down to where they started from. I think it's not surprising that they're happening with such a lag because it was so hard to get workers. And I think your point about how the largest, healthiest companies are the ones laying off first maybe underscores the dynamic we saw in that they had the easiest time hiring and retaining workers because they have the ability to provide so many benefits and 401k matching or whatever it is, and fancy cafeterias. And so the Googles and the Amazons, etc., maybe didn't have as hard a time hiring workers and retaining them as your mom and pop shop or the local restaurant down the street. And so if you had a hard time finding someone and you just got them a couple months ago, your desire to let them go the second sales turn down is pretty limited. You want to wait and see, is this a prolonged downturn? Is this just a blip that we're going to sustain? Because we don't want to have to go back and try to search again to hire workers who are hard to find. We all know the labor dynamics in this cycle are really unique following the pandemic experience. The number one input, obviously, into hiring is profit growth. And I've been forecasting a profits recession for more than a year now, based on the margin squeeze that we've been seeing in terms of, relentlessly high energy and other commodity prices, at a time when the ability to pass those on to consumers who are increasingly spent up and lent up is really diminishing. And, like I said earlier, they had been running up their credit cards to try to keep up with it. And now their appetite to do that seems to have hit the wall. So this is a real problem going forward for corporate profits. And I just checked before we jumped on here as to what the estimate was for 2023 S&P earnings growth. And they're down to basically zero growth. They're still not forecasting a recession, but we've come down from, 10% plus earnings growth in 2023 to zero. On its way to minus 20 would be my expectation. And that sounds like a ridiculous number, but one of the tightest fits, other than the profit margin proxy that I look at that tracks, input costs versus the ability to pass them on, is CEO confidence. The Conference Board comes out with a quarterly survey of CEO confidence. And if you go back to the beginning of the survey and chart it versus growth and profits, whenever it's this low as it is right now, you've seen a 20+% decline in earnings growth. So it's not out of the realm of possibility, but we just have to start moving in that direction before the stock market realizes, okay, we've been a little bit too complacent about the outlook here.